Crypto volatility explodes as technical levels get taken out to the downside, triggering more liquidations. Trump comments over the weekend about a crypto strategic reserve made the market gap higher, but this move was faded quickly as risk assets melt down on more trade war concerns. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran from Options Insight. I've got my man Dave from FRNT in this lovely, shiny studio. And we've got another special panel episode today about prime brokerage. But before that, we're going to give you our short and sweet update on markets because, my goodness, this market has been volatile.
Man, massive moves across like the whole risk spectrum. But obviously,
S&P's tanking now as well. Yeah, down at 57.50-ish.
I think I spoke about this macro regime shift, which ultimately like plays out to be positive, but characterized by dollar selling off and yields coming lower, right? And it's quite a big shift, and I think part of what's driving that is we're transitioning from this fiscal dominance, right? That's kind of kept rates higher, inflation higher, growth higher. We've now got a US administration that's talking about trying to reduce deficits, right? Get those under. Besant wants to go from 7% deficits down to 3%.
They're kind of engineering a mild recession, it feels like.
Yeah, and the implications of a growth slowdown, obviously Trump tariffs, all that stuff kind of feeds into this idea that we're going to see a growth slowdown. We're also seeing the actual data softening, and we've spoken about how start of Jan, everyone was talking about 10-year yields going to some silly number, this US exceptionalism, strong growth, all that. We spoke about that actually Q4 was living off this sugar high from the pre-election spending and expected that to fade. So that's been like quite a big part of my underlying kind of macro thesis into this year, which is playing out really well. The problem when you have macro regime shifts is they often come with a lot of volatility. And I think part of that volatility is because you're seeing these popular levered momentum trades get blown out, right?
Nvidia, for example.
Yeah, and a lot of like sort of Trump trades, if you like, coming into this year, which was short bonds, long dollar, long Bitcoin, long NASDAQ and all the tech stocks. And they're all blowing up right now. So you're seeing the momentum trade unwind and that leverage unwind, just driving a broad like de-risking across all markets. Reminds me a little bit of what we saw in August, like when we had the carry trade unwind sort of thing.
Yeah, that's certainly what it's starting to feel like. VIX is popping up near 30 now.
Yeah, and so what you just have this massive, what I call a grossing down of risk, where all risk gets taken down, even positions you like get taken down.
Yeah.
And so they're all getting kind of shot. And you kind of just have to ride it out. And it tends to, the de-risking comes very mechanically, like the models are telling you, right, you have to now take risk back down. You're getting taps on your shoulder from your risk guys, got to take risk down. But
it's right on schedule. March is known to be a seasonally weak period for the S&P, and also generally a strong period for volatility for the VIX. So, we've been saying to our subs at Options Insight about this March correction that we were getting ready for, certainly on the S&P, but also generally risk assets. But we see that as a buying opportunity. We don't see that as something to like panic and get out of all of your investments. It's like, as long as you are able to have some dry powder, maybe get some hedges in place, now's the time to be thinking about monetizing those hedges and getting yourself ready for the bottom, which might be here, might be 5% lower, who knows? Yeah. But it probably plays out in March, I think. Maybe into April, but March, April time, I think we get some sort of bottom in risk assets, and I'm certainly looking towards some sort of risk rally going into the summer. Yeah,
I think, to be honest, this week is feeling like that kind of what I call a crap out week where we probably do find a local low. I say it's really difficult when you have a de-risking. It's really difficult to pick that bottom. I say because it's going to become very mechanical. It's not even about levels so much as it's just risk unwinding itself. But then what happens once that stabilizes? Then you kind of get the new trades put on for the new regime. And I think right now, say that's going to be short dollar, long bonds because yields are coming down, right? I still think long Bitcoin is going to be that. And obviously we've had all the Trump stuff around the crypto reserve. So those trades are going to get put on once we've gone through this sort of de-risking.
It's a sequence, isn't it? You have to get enough weakness to trigger the easing. And then when the easing comes, then we can recover.
Yeah, right? I think as well, like adding to all of this of geopolitics as well, and what's gone on with Trump and Russia, Ukraine, and potentially pulling military support for Ukraine. Obviously, all this is weighing on risk. I think the other thing as well, like the Fed turned hawkish at like top tick the market in terms of from an economy point of view, and now the market's panicking that we're seeing. I mean, like Atlanta Fed GDP now forecast is like minus 2.8% or something for this Q1. Now that it's a pretty poor forecasting tool, and it's very volatile to like each kind of data piece. But clearly, the data is starting to deteriorate, and we've kind of but the last we've kind of heard from the Fed really is that everything looks great. There's no need for us to cut rates. So then the market gets in this panic of they're not going to cut rates.
They're going to deliver the rate cuts.
And then the worst scenario from a risk perspective is stagflation, right?
But isn't the rates market starting to creep some cuts back in?
Yeah, it's starting to creep it in and the risk off. I also think as well, like we had Truflation on the show, right? Truflation now is at 1.44%. So real-time inflation is coming lower. But you know, even though we've got this kind of sticky inflation, Powell's already said, like, if the labour market starts to suffer,
well, it's going to because
they will cut.
Doge is firing how many people?
Yeah, and well, and the public sector and public sector hiring was a big part of actually what kind of was underpinning employment all of last year.
You saw the
private sector
was jobless claims last week, right?
Yeah, so I think the market is massively underpriced for the Fed. The Fed discussion right now is like they continually fuck this thing up, right? Their discussion right now is how are we flipping dovish from this, because we just told everyone we were hawkish. Now, like the economy is like, you know, kind of looks like it's deteriorating. How do we now kind of put a dovish message whilst maintaining a level of credibility? But they'll have to, and you know they'll have to do it. And I think the kind of phrase they'll be using now is that the downside risks have started to have increased relative to where they were back in December, and that will give them the cover to start cutting rates. And I think as soon as they start doing that, then the market breathes a bit of a sigh of relief that, okay, so the Fed's hands aren't completely tied.
So the Fed's on the 19th of March.
Yeah,
this is really interesting, actually. So if the Fed does pivot towards that type of language, that could be the timing around, you know, the timing into that Fed meeting could be around where you get your low in March, which would be bang on schedule in terms of like the seasonality and stuff.
So it's interesting. I mean, we'll see non-farm payrolls on Friday is going to be super interesting. I mean, you get.
That's not going to include the Doge cuts, so that data is going to be inflated.
Yeah, but like, you know, who knows? You get a really low print on that. That might be something the Fed can use. I don't know. It feels we're too close to the March meeting. It feels for March to be on the table, but there's not a meeting in April. So then they're looking at May.
Just panic cut in May then.
Probably 50 bips in May, but I think the market will start to price that. And this isn't. And by the way, this isn't someone going, "Oh, markets are down. You need to cut rates." I'm like, no. Look at the data flow right now.
Yeah,
and it looks pretty soft. So, look, I think we go through the deleveraging. Lower rates.
You got your hedges on, people. Yeah. I've been banging on about hedges for how long?
Speaking of which, how are your
so I mean, I've got different strategies, right? I've got income strategies, I've got hedge strategies. I would have loved if I put all my crypto into my hedge strategy because that's performed beautifully, right?
I'd love it if I put mine into.
Yeah, so we've had like a 15% drawdown in Bitcoin, and I'm down probably less than 5% in that strategy, right? So the hedge has done its job.
Yeah,
and it's not like I top ticked it and put my hedge on at 108k. So I'm talking about, I think I started the strategy middle of Jan. Market went up against me, but obviously I was long with a hedge, so I was participating in the upside. And then we've come down. I've been systematically rolling things or whatever to maintain a hedge. I actually added a little bit to the hedge before we broke 92k, and then I've started monetizing the hedges as we've come down in towards 80k or whatever, right? So that's performing beautifully. The short gamma structures like the iron condors have been getting blown up to smithereens. And so, you know, I probably need to do some work around scaling those strategies based on where we are. Right? If we're trading in a range and we've been in a range for a while, then your conviction that we're going to continue to trade range bound is higher. But when that range breaks, you probably want to be shrinking down those sort of premium earning strategies, because it's like, all right, all bets are off now. We don't know where the new equilibrium range is, so just scale those down. So that's probably my learning that I've had from running systematic strategies. It's like, you shouldn't always have the same size through all the different market regimes. You should have kind of an allocation model where, based on what regime you think we're in, you pivot more towards the hedge or more towards the carry, that sort of thing.
And by the way, what's really interesting in that, all these big, and that's my point as well, all these big systematic models, momentum models, that they're all getting that signal that you need smaller size right now. So that's what we're seeing. That's what I talk about, this de-risking.
Yeah,
and it's really scary, right? And by the way, like if you're underwater on this stuff, it's super scary. But I think my message is the environment, the macro environment, is actually, let's say, pivoting to a more supportive environment with dollar rates all coming lower, liquidity that's pumping in, TGA drawdown. TGA started to draw down as well. All this stuff. So positive liquidity, lower rates, lower dollar, explosive mix for crypto and risk generally. We just need to just be really, really kind of cautious around, I guess, like your position sizing if you're trading this market. But yeah, like you just got to kind of ride out the de-risking. But I still think very much we're still in a positive environment for a continuation of this bull run.
Yeah, and on the vol side, I'll just wrap up on the vol side. We obviously saw a big pop in vols, talking about 20 vol points in the front end of the curve, but realized vol was up even more than that. So realized vol on Bitcoin's like 95, ETH's like over 120, so crazy numbers. So the front end ETH is about 90 vol. Skew's obviously gone a bit ballistic for the puts in the front end, but the big regime indicator that I keep talking about is long-term skew. And long-term skew, it's not even that long-term, but like anything from June onwards is still in call premium, would you believe? Right? So the front end of the curve is flipping dramatically to puts. 6 vols for puts on Bitcoin, 20 vol for puts on ETH. But when you look at June, it's still marginally for calls. So that, for me, I'm almost seeing that as a bull market regime indicator. When that flips to puts, I'm like, okay, I'm going to have to hold my hands up and admit maybe the bull market's over. But until that long-term skew goes into puts, whilst it still stays in calls, and the only skew that we see for puts is the front end, that is telling us that this is still a correction that's in play. We don't know how deep it's going to go. Market's kind of shitting itself about ETH right now and thinking ETH might crash, which technically ETH looks horrible, right? Which is why I think there's a very strong put premium on ETH for that reason. But yeah, until long-term skew goes into puts, I'm still saying this is a correction and it's probably a long-term opportunity to buy. All right, guys, that is it from us two. Now we're going to move on to our panel discussion for this week. All right, so today's panel discussion is about prime brokerage within the crypto ecosystem. So it's my pleasure to introduce some of the big heavyweights in the space. Guys, welcome. And why don't you introduce yourselves?
Sure, I'll kick off. Thanks for having us. First and foremost, my name is Mike Higgins. I'm the international CEO and global head of corporate development at Hidden Road Partners based in London. Prior to joining Hidden Road and setting up that business 6 years ago, I spent just shy of 20 years in electronic trading, multi-asset, and the bulk of my time in the foreign exchange markets. Very briefly on Hidden Road, we are a multi-asset PB and clearing firm that was set up and funded by the buy side. So that's a sell side business funded with buy side pension fund capital. We've effectively done two things. One is we focused hard on improving the technology behind the core infrastructure of prime brokerage, clearing, and margin financing. And applying those applications in digital assets. And then separate to that is we took an innovative approach to bring balance sheet into the space by tapping into the large pools of private credit. Thanks for having us again.
Tommy Doyle. I run our European franchise at FalconX. We're also a global prime brokerage based in San Francisco, formed in San Francisco, so a very technology-first approach, and has now spun out to New York, Europe, London and Malta, Singapore, Hong Kong. Much like our peers here, we're now a global business. We basically do three things. We trade, we lend, and we clear, which we'll dig into, I'm sure, each vertical during the podcast. And similar to Mike's HRP, we've been around about 6 years now. Prior to that, actually, prior to joining FalconX, I was in TradFi for 20 years, and then a short stint at one of our peer groups.
My name's Sean Lawrence. I'm the head of Europe for LTP. Prior to joining LTP, I was 30 years investment banking and then 4 years in crypto, and I joined LTP late last year. LTP is an Asian headquartered prime brokerage firm, and we do really straightforward prime broking, so nothing strange. It's regular market access and clearing and kind of middle office, back office, lending and leverage, custody and safekeep, and then tech services, colos, and those kinds of things. We are a global firm, kind of course, dominated base in Asia, but of course, we are global client base, kind of global access in terms of markets, and of course, super happy to be here with Deribit, who's we understand the best exchange in the world.
Brilliant. All right, cool.
Well, welcome, guys. Yeah, thanks for coming on. I'm looking forward to the conversation. I guess the first question and the obvious question to ask is, what actually is prime brokerage, and particularly what does it mean, but also what does it not mean? And I don't know, Mike, if you want to kick off with that.
Sure, yeah, certainly. I think to keep it in its simplest form, it's prime brokers are access providers, access to two things. Number one is access to liquidity. And so that's liquidity across many destinations. In the digital asset side, there's the native crypto exchanges, there's OTC pools, and now you're seeing more products come on the TradFi rails. It's access to all of the products across those. That's spot, perpetual swaps, futures, options, more recently ETFs as well. And so it's important that the access is, determined by the client, right? For them to figure out their routing, because over time, it will be the fiduciary responsibility for institutions to source best price and scan the market to deal on the best price. So that's the access to liquidity. The second piece is access to balance sheet to make trading across all of those a capital and cost efficient way. If you look at the infrastructure in crypto, it was very much designed early on by retail. And so these exchanges are all pre-funded, which by definition makes this market capital inefficient. And so I think over time, you're going to see the market attract scaled up intermediaries. Prime brokers or leverage providers will be one of those.
Good stuff. I mean, obviously, we're all here from traditional backgrounds. We're all used to prime brokers in the traditional space. Crypto is obviously very different, but also the same. Same, but different. What are the structural differences that you see across crypto and TradFi? And as a prime broker, what opportunities does that provide? And also what risks and challenges does that provide in trying to provide that prime brokerage service into the space? I know, Tommy, you're looking at me. If you want to think about that one.
So to follow on from Mike's point of the role of a digital prime broker, effectively to trade and to lend and to clear, right, as three sort of key verticals to that product or to that offering. I think a lot of us are actually the three of us were talking prior to the podcast. There's naturally going to be a comparison with the traditional prime broker, and so even in those verticals, we're doing very similar functions to a traditional PB. I guess from a market infrastructure perspective, that's where we differ, right? And so Mike touched on pre-funding being a prerequisite requirement within crypto. And so therefore this capital inefficient framework that we have to navigate around. Also a lot more fragmented liquidity, right? So to Mike's point on access and being able to access through a secure and safe environment, global exchanges, to access that fragmented liquidity and take advantage of the market inefficiencies. From where we see within FalconX, having had, our cap table is very much the buy side traditional institutional investor, right? And so we have Fidelity, Wellington, Tiger Global, GIC as investors into FalconX. Our approach is to try and provide a traditional prime platform to that crypto infrastructure, right? And so we don't perfectly overlap what a traditional prime does. But we do take it from a risk management lens. How can we provide stable liquidity across a trusted, secure environment and lend into that ecosystem? And I think that's where all three of us will probably have a lot in common actually across all platforms. And so going back to the question on traditional prime versus digital prime, yes, they're different. I mean, our average size of our client is obviously going to be very different to your average client in a traditional prime broker. There's lots of rhetoric on, when those traditional prime brokers will and can get involved in crypto. Clearly, the main barrier that they face is Basel currently. I think that's something that's probably, and I'd love the panel's view here, that isn't touched on as much as if and when traditional primes do get involved in crypto, a lot of the clients that we face mutually may not meet the hurdle to be covered by those traditional primes, right? And so, what's the role of a crypto prime broker post Basel reformation, which I think we'd all agree will happen at some point in the future.
Yeah, can I kind of tail off that? That's quite an interesting point. And it comes back to the question of intermediation. And so one element of our industry says there should be no intermediation. It should all be on chain and it's all decentralized and those kind of things. I think there's a certain naivety in that. And then there's another element which says, to your point, well, when the big banks, they decide to come, of course, their balance sheet and their credit, quality and all those kinds of things. But it ignores the fact that there is differentiated credit quality in our asset class, which is unlike TradFi. TradFi has very homogenized risk, homogenized kind of balance sheet, homogenized asset servicing, and in a way that you go back to the 70s and 80s, it's like crypto is now. Lots of different players, lots of different risk appetites. And so when we kind of pull forward into what crypto and particularly crypto primes do is provide an intermediated, credit access point, but then there's an intermediated credit access point on the other side of us. And maybe that risk is offset to dealer brokers, or maybe it's offset to proprietary trading firms taking, direct principal risk, or maybe it's credit intermediated to some more crypto-friendly, dealer brokers or prime brokers. But there's a place for prime brokers in crypto, I think, at the moment, which is being the trusted intermediary between different sets of credit pools or different sets of credit risk appetites. I think that's a legitimate kind of description of the difference. The other element, which plays to your question is, when you look at traditional finance, there are agency clearing brokers, SocGens and ABNs. There are dealer brokers, Goldman Sachs's and Merrill Lynch's. And there are execution brokers, TCAPs, TPI caps, and the likes. And I think what you find in crypto is that there's far less pure prime clearing brokers, and there are many more prop trading firms calling themselves dealer brokers, but they're not really brokers because they trade their own book and they have their own risk position. And you find a lot of dealer brokers who don't necessarily, and I'm not saying there's anything wrong, but I'm saying they don't necessarily hold up the ideal that the client is the primary decider of the transaction and the risk that they want to take.
So they're taking principal risk as well.
There you go.
Okay, and then it's kind of, but is it Chinese walled or not really?
Well, look, I mean, I couldn't say because I don't know these firms, but I think in crypto you see this weird blending of archetypes. So you get custodians who do execution, and you get exchanges that do all of the elements of the industry, and you get hedge funds that are really broker dealers. So I think the question of labeling is quite.
I think that's a great point, actually. And if you look at traditional finance, for instance, you have even this conception that or misconception that a traditional prime all do the same things is not true, right? Having worked at prime brokers, some of them have their niche. Some of them are quant PBs, and they're just stronger with systematic clients. Some of them are offering FX PB, and some aren't, right? And that's created opportunities for Hidden Road and others to step in there. And I'd love to explore that with Mike actually in a second. And so, this reflection that, and you guys must see it as well, but you're offering slightly different to Hidden Road and LTP. That's okay. Right, that happens in the TradFi world as well. Like, you back what you're good at. You've got the discipline to invest in the vertical that you believe you could provide a USP. And I think that's quite what's interesting about our three firms is we're all very solid firms, have survived and have been crisis tested across a variety of things right over the last few years, and stood tested to be still standing and have a big businesses and global business, yet all not doing exactly the same thing. Right? And I don't think that's a bad thing in itself.
Yeah, no, I'd agree. I two comments. One, again, I think from a prime brokerage clearing standpoint, there's lots of pools that you need to clear, right? And so you're starting to see the convergence or the bridge between the traditional markets and the native crypto markets. One of the biggest trades is a basis trade, right? So I'm long spot crypto, I'm short CME front month future. There are very, very limited FCM, GCMs on the CME that would even give you a risk envelope at all on the CME, let alone take Bitcoin as good collateral. There's one, that's Hidden Road. And so are the banks going to come into that space? Well, let's look at the banks. Clearing in a bank is sub 5% return on invested capital. It's a bad business. If you look at the number of FCM, GCMs on the CME in 08, there was 150 so, and now there's 61. Don't quote me on the numbers, but that's the magnitude of what we're talking about. Citibank was the largest FX prime broker, pulled out of that space. So now imagine you're in a bank and you walk in and you decide to say, I have a great idea. We should offer prime brokerage in digital assets under 100% RWA haircut. That's a crazy idea. There's no economic incentive for a bank to come in and do that, at least at this stage. Now, what will the banks do? The banks are going to be a great place to hold assets on pledge for the industry. They should be custodians. It's not surprising SAB 121 in the US was repealed for the largest custodian in the world, Bank of New York Mellon. They hold $50 trillion of assets, guys, 50 trillion. That's a name I trust, and I'm going to hold my assets there. Do I want them doing my execution? Probably not, right? I want them as a custodian. And so we get these blurred lines that both of my colleagues were talking about, which is, the FTX is a perfect example. They custodied the assets of the user. They ran a marketplace, and they also ran an internal trading desk against it. Those bundled services or vertically integrated setups are ripe for failure, and that's exactly what happened. And that will continue to happen until two factors either push it. One, the governments and the regulators move it towards a horizontal structure, or the institutional clients come in and they say, I want my custody here, I want my liquidity here, I want my execution here, and I want my credit in a different place. And that requires different types of services to come in. But ultimately, I don't think the banks will be in the credit side of this in short order. And just to wrap on the banks, I think they'll hold assets on pledge. They'll be a great source of repo for euros, dollars, sterling, and yen. They probably come into trading because the margins are higher, but the clearing and custody side of it, I don't think we're near that yet.
So you mentioned FTX. I mean, obviously that wasn't very long ago, right? We're talking about a couple of years. But my question would be, how much has that changed the way businesses like yourselves have had to kind of operate, and what have been the implications of that huge, spectacular blow up?
So if I take that on?
Sure.
So I think FTX manifestly and materially shifted market structure, and it shifted market structure in a way that generally was coming in our way. And the reason why was because before then you had people who didn't care about credit counterparty risk, didn't care about connectivity risk or how much they needed to invest in infrastructure, technology infrastructure, and these kind of things. And so when it happened, I think everyone had to really think about the choices that they were making. And so where people like us step forward and say, hey, we have a value proposition which is technically, capable and secure, and the infrastructure is robust, and at the same time we're heading towards, good balance sheet, regulated, operating model globally. At that point, I think was the right point at which people went, oh, there are risks in this asset class and there are risks in this industry, and we would step in and and catch that. So I think that was quite an important pivotal point for getting people to really think about what they were doing with their choices.
It was like the Lehman's event in crypto, but there was no one to bail it out.
Yeah, right? And the really interesting dynamic was, if you look at balances on-chain and off-chain, when that thing happened, I thought to myself, well, everyone's going to go self-custody and we're all going to head towards DEXs and this kind of thing. Totally the opposite happened, right? It all went onto intermediaries. A lot of it went on centralized exchanges, but also a lot of it went into people like us who would step up and go, yeah, the thing that we've been presenting and projecting for a number of years, which is, like I said, good quality balance sheet, regulated, good, secure, stable infrastructure. This is now the time at which you can, have access to that.
Just to jump in real quick, I think, for the market to engender confidence, market participants have to recognize the value chain that gives them access. This vertically integrated setup is a challenge. There was two problems when we started. Number one, there was this credit risk in the system that wasn't being valued or priced properly or priced at all, frankly. And the second was the infrastructure setup. And so you've seen these blowups. And so the world is inexorably moving in the direction of a more mature market infrastructure. And I think as the market structure matures and participation broadens across the industry, you'll see this look more like FX, probably with better legal and technology standards, more conformed technologies, and more robust operating procedures. But FTX was a major event. Was it the Lehman Brothers of crypto? I'm not sure, but I think when I point back, actually it was the unsecured lending market that was the biggest problem. People were getting sizable loans, uncollateralized, not only uncollateralized, but with no audited balance sheets. And so the best practices in TradFi are classified as regular financial transparency according to GAAP and IFRS. There are major players in the industry that do not give you financials, let alone audited and timely financials. Those things need to change for institutions to come in, and we'll play a role in that because that's what we do, is provide balance sheet and transparency and regulation. Ultimately, prime brokers are trust providers.
Yeah, I think to finish off on FTX, it's a great example. And maybe we align that with discussing ByBit and what we've seen across the three firms last week. If you look at FTX, there were learnings for everyone. I think as an industry, though, it's flushed out a lot of the providers, to Mike's point, that just didn't have a sustainable business model, right? And so if I wanted to start lending out uncollateralized, and that's 90% of my book, at some point the cards come tumbling down, right? And we had, a variety of different issues, right? Lunar, the BlockFi, Celsius, and then FTX, which, let's make no mistake about it, was fraud, right, as opposed to anything else. But I think if we look back at ByBit and the transparency that we get from being on chain, and we compare that to a Lehman, I think that's a real an advocate for why is crypto so well backed and so well supported globally by these institutions that invest in firms like us. And I think that's the transparency that we saw from ByBit, right? The CEO was on the tapes. It was all very clear. We've been hacked, right? Lehman was very different. Lehman was, no one knew what was going on.
Everything's fine.
Everything's fine till it's not, right?
Yeah.
And so they were very open. The transparency was there. Our three firms were out on the calls to our clients. It took hours to get the balances off, right? But that's the role of a prime broker. I think, your USP from that scenario as well is you just sit higher up the ByBit ranking when something like that happens, right? And so let's face it, ByBit we're calling Hidden Road, FalconX, and LTP, and making sure we're comfortable before they spoke to any of their direct clients, which are probably further down the ladder. But yeah, I look at that and think, hasn't the crypto market evolved in a long way since FTX, where the actual market accepted it pretty well, right? All things being considered, and coped very well, right? And so our clients were very pleased with not just the way FalconX handled it, but how peers like our LTP and Hidden Road did as well.
From a credit intermediation point of view, like how did just like almost practically the ByBit thing work? So clients on your respective platforms, they're looking at ByBit, people can't get their collateral off of the exchange, but they've got a prime broker. How were those using a prime broker at an advantage maybe to someone that's just trading directly on ByBit?
Can I answer this one first? Because it goes back to the FTX example. But when Hidden Road, looked at this, the goal of digital assets was to bring an approach that was trailblazed by other asset classes in the prime and clearing space. And so the way that market works in other asset classes is I'm your counterparty to your trade. I'm your settlement agent to your trade, right? And so if something else beyond that happens, I'm on the hook, right? And so Hidden Road effectively protects its counterparties from an exchange default. Unfortunately, FTX was an example of that. The counterparties that subscribe to our product that is akin to a CDS were made whole immediately. We think that's really important for institutions to have confidence of where they're trading, and that's why they face me and do their due diligence. And so with ByBit, it was slightly different. ByBit was a hack, and it wasn't clear that this was going to default. To Tommy's point, it was exceptional how quick Ben was, in public saying, it is true, we were hacked, we are getting bridge loans to support the business. And the on-chain transparency was just helpful for the industry, and the industry got behind it. Should that have moved in a different direction, then again, the counterparties that are facing a prime broker like Hidden Road, their counterparty risk is me. And so then it comes back to, well, what's Hidden Road's position? And so prime brokers do four things. Number one is they're experts in underwriting counterparty credit risk. That's what we do for a living. That's what my actuaries do. The second thing is we manage liquidity. That's liquidity on my balance sheet, right? Not in the business of rehypothecating client collateral, because that's how you get a run on the bank. The third thing is managing term liquidity. If you have margin financing loans out to counterparties, what are those terms and when can you pull those back? And the last thing that's probably the most important is you set appropriate limits. Because in those scenarios, while a ByBit or an FTX was an interesting time in the market, if your prudent risk management's there, you're within your limits. It's a bad day. It's not the last day. And so I would say counterparties from Hidden Road were comfortable communicating. We managed through it together, but we're well protected.
And that level of transparency that you had with this ByBit episode, Is this something you can see happening longer term in TradFi as they start to use this sort of technology that crypto has and all of these sort of on-chain measures that people can see what's really going on? How far away from that do you think we are? And what are the hurdles to get there?
Great question. I think building on from Mike's point, right, the role of a prime broker is very clear from that ByBit hack, right? You have direct line into the CEO of the exchange, right? And you've got clear communication on what's the delay in withdrawing your assets. And so I think that's one benefit of using a prime broker, any of the three, that was well received. To your point on traditional finance maybe learning or moving in a direction of the transparency, I think that's a wider argument on TradFi exchanges going on chain. Do we look at private chains, public chains? But I think it's fair comment to look back on that hack and go, okay, actually, all in all, it was well communicated. It was managed well by the key market participants across the board. And I think crypto as a whole came out well from it, actually.
Can I so I agree with everything they've said. There's an interesting dynamic of crypto. I read a analysis by some university professor, and they said one of the challenges with crypto is the fact that there is that transparency and there isn't a natural lag of information in the market, which means that crypto is broadly more volatile as a result. So when you have an event, someone can see a balance sheet's disappeared, then suddenly everyone's all short the stock or whatever it is.
The clearing flush out happens quicker.
Absolutely, because it is that more transparent. But if you kind of go, oh well, that's kind of interesting, and it plays to the strength of the underlying technology and all those kind of things. But I think if you really draw an arc of history, you can go, okay, that's fine. We'll all adapt to that, right? And so there'll be different challenges and different risks that come from that. But you'll also have a materially beneficial market, call it credit quality or investor kind of comfort event of being able to see everything much more clearly. Right.
It's funny though, because like TradFi markets, they have circuit breakers, right? So for example, the S&P can't be down more than 10%. It goes into an auction period and then it reopens and it goes again.
Yeah.
Crypto just doesn't have that. So
doesn't have it. Yeah,
we can have like a 50% down day in crypto, which you can't really have. They'll shut the market in TradFi.
Equity's down 10%. The Fed are cutting rates.
Exactly. Well,
definitely don't have that.
You never know. It might happen this week.
The way we're going.
Yeah. But there's an interesting play on it, though, right? Because what you've just described were like central exchanges that are highly regulated and put those circuit breakers in place. If you look at the DNA of digital assets, I mean, this is largely an OTC market, and so foreign exchange, if $1 goes to zero, there's no one jumping in, except you have bigger problems with the Bundesbank backed by the ECB type of approach. But I agree, and I think that's just again that maturing of the asset class is to put things like this in place. I think the derivatives will move to exchanges, and so having circuit breakers, I think, would be a great idea.
Can I also agree with you on that? Can I also kind of follow on what I think you were mentioning earlier on about the role of prime brokers and as it relates to things like exchange collapses? ByBit did a fantastic job, and without, I think, exception, everyone that we've spoken to, clients and kind of post kind of event, kind of debrief, everyone says top marks, 100%, all feel more comfortable. But if you look at it from a market structure point of view, there is also another element, which is where the centralized exchanges also try to behave in other elements of the ecosystem. Let's say, for example, they want to be a prime broker at the same time as an exchange. One of the challenges there is if they're acting as the prime broker for the client and they fall over, the client's totality of their business through that prime broker is affected. Whereas we're independent from the venues. And so firstly, as a client looks at us, and it's the totality of their market risk, which may not necessarily be on that one venue. And secondarily is where we're managing, I think the guys made a good point about how we develop relationships, both technically and from a business point of view with exchanges, so that we can interact with them and understand. And there's a little bit of kind of managing the message and understanding what's real from a risk point of view now versus in a minute's time and in an hour's time. All of that ability to kind of manage a crisis, I think, is quite important, that you wouldn't get if you were either a tied broker or a centralized exchange that was also offering prime brokerage services.
Speaking of credit risk in the ecosystem, is there any central place to go to see what the credit is of various entities within crypto, or is that being built out anywhere?
That's a great question because it comes up quite a lot actually in our transactional business. When we were all big lenders to the ecosystem, I don't think credit risk is priced correctly, if at all, right? And so there's a clearing rate these days for the cost of cash. But going back to your point on FTX, the one thing I think we haven't learned from that lesson of the BlockFis and Celsius is to price credit risk appropriately, right? And so, I think the ecosystem's become more robust. There's less but stronger players, well capitalized, who are able to navigate the ByBit instances with bilaterally, right? And so ByBit did a fantastic job as well. But make no mistake about it, I mean, we're lenders. We all had auto liquidation procedures and models in place where we're not exposing our investors to risk there as well. So to the extent that an exchange goes down 50%, we're out well in advance of that, right? Just systematically. But I think the credit risk comes up a lot. I think that is something that needs to be priced. And like, what else do we need to see as an ecosystem for that to be actually priced correctly?
I completely agree. I guess a couple points to highlight. So there is no credit market quite yet, and I think that if we do start to see the evolution of a CDS market, that would be that we're moving in the right direction, but we're not there yet. The other thing is, like, if you look at Basel under banks, right, they can rehypothecate a certain percentage of client assets, but they also have to hold regulatory capital against this. Most credit providers don't blow up because of credit risk; they blow up because of liquidity risk. And so and that's part of your risk management framework. And so I think what should happen in this market is that we do one thing. We separate the function of trading from the function of asset holding and collateralization. And by doing that, it'll lead to best practices across both of those disciplines. What I mean by that is take your assets and post them in a tri-party custodian. So send dollars to Bank of New York Mellon, sell dollars, buy some QSIPs, earn the positive carry on some treasuries. Have your prime broker use its balance sheet to finance trades across all of those liquidity destinations that you've traded. So now you've separated your IM, your initial margin, from your variation margin. Your variation margin is at risk. But so long as you sweep that, and I should charge you more to keep your variation if I'm protecting it from where this could default. And so that creates the right incentive for counterparties to sweep back that variation. And so I think that's how we're going to scale going forward, again, in this highly fragmented, largely OTC market. The other thing I'd say is just looking at the recent rally, right? In terms of volatility that you've seen, right? And so you've seen, the new administration come into the US. You've seen, record highs in Bitcoin. But if you actually look at the total amount of volume, it hasn't actually increased because there's a credit problem because the credit is not priced and the infrastructure is not really there for institutions to fully come in. I mean, I think everybody was high-fiving each other, right? And BlackRock's coming into crypto. BlackRock came into crypto trading ETFs because the current infrastructure was not successful for their liking. And so I think that by solving the credit part, you will actually unlock the market and let the market kind of find its full expression. So a lot of work needs to be done there.
The point you make about the ETFs is interesting because we saw a lot of outflows last week, 3 billion or something, right? And it kind of speaks to the point that a lot of those inflows were not sticky money, institutional capital that's in it for the long term, which is kind of what the pitch was, right? The pitch was, the reason why we have to have an ETF, because all this institutional capital that needs a safe instrument to come into the space. Well, we broke down below 80 and they all started puking it, right? So there's probably quite a lot of fast money using those ETFs and doing basis trades or whatnot, right?
Yeah, I think it's a good point. I guess maybe it's expectation management of be careful what you wish for. So in terms of institutional adoption, like anything, it's a journey. It's an important first milestone. So, full credit to Coinbase for partnering with BlackRock to get that done. And obviously there's other ETF issuers and other custodians out there. But I think that being the landmark name and partnership paved the way for others. And Fidelity have put in a lot of work as well, right? And credit to them. But now we have a suite of credible asset managers with ETFs, which is 11, I think, now in the US. To your point on, is it sticky money? I mean, it's a 60 vol, 70 vol asset class. And so the expectation for me is if an investor, even institutional or not, is coming into that volatile asset class, unfortunately, the market will go down and we will see some redemptions. I think the better analysis or the more meaningful one for me is how many of those come back in when we see a rally, right? And so I think it's a very fair point, but let's see the rally through and whether it's the crypto strategic reserve in the US, are some positive headlines on, more the offshore exchanges, international exchanges being adopted more broadly in Asia, and keen for LTP's view there, actually, given your growth and market share there. But I think that institutional adoption, we are getting towards it's Bitcoin and everything else market as well, and I think we've created that, right? Because we put the rails around Bitcoin. Bitcoin's got the liquidity, and unfortunately, if you're $1 trillion asset manager, you're going to be constrained by asset class size, and so it's a bit of chicken and egg as well. But I think it's a very important step to then move into crypto native, and so we haven't seen the mass adoption from those new institutional investors into crypto native yet. And actually, I was in New York a few weeks ago, and if you speak to the crypto funds, great, very pumped up and amped up about Trump. Very few of them have actually seen any new institutional investors come in, right? It's still family office money. And so, institutional adoption for me isn't just expressing the risk and actually putting capital direct into tokens, but it's investing in the managers that we all face and support as well. And we're not really seeing that yet. We're still seeing family office driven investments, more so from the sovereigns. And I know you're making inroads in Abu Dhabi, so we can touch on that. So there are lots of positives out there as well, but I think that's still a missing bucket of, and then we can talk on with the roads to getting those big institutional endowments, but that's a long road. I think we're still probably only halfway down that.
You've just covered about a dozen.
Topics. We should probably cut that out. take like one of them. Yeah.
But I'd definitely like to talk about the institutional money, but just very briefly to come back, kind of maybe tail off the question. I think there's an interesting element about credit counterparty risk and credit intermediation, those kind of things, which is, to a certain extent, we're noticing that investors are using a proxy, which is your license status, as a way of not being able to understand the fact that there is no ability for people to understand credit risk, credit counterparty risk, really in the industry. And so, to kind of plug our case, we just got our Hong Kong SFO Dealer 1, Dealer 2, the Asset Manager 9 and 4 licenses under the traditional finance regime. So there's dual regime in Hong Kong, there's crypto and there's traditional one. We got under traditional partly because my colleagues here, we look at this as an asset class amongst other asset classes, not taking over everything that we do. But also that's driven by client demand. Clients are going, okay, so how can I know you're trustable? And I go, because there's people whose job it is to assess us, the regulators, the inspectors that you have to go through to be able to get your licenses. These are the people that you can rely upon by proxy until we get to the point where the whole industry is a lot better, kind of structured. But so I think there's a kind of proxy, which is regulatory status.
No, I think that I'd like to follow on the back of Sean on that. I think regulation is key again for the transparency that we need. But beyond that, the tier one regulators, you have capital requirements, right? And so unfortunately, if you look here in the UK under the FCA, digital assets are recognized as not good collateral. Mm-hmm. So they don't count. So if you have positions against those, you need to put your balance sheet up. And so if you allow clients to put positions on, then they know you have a balance sheet because you're audited by the FCA on a daily basis. And so it's not just like, is it a check mark? Are they regulated? In these tier one jurisdictions, that's a requirement. And so as you start to move and just, quickly on Hidden Road, we're regulated in the US by the CFTC and the NFA, the FINRA and SEC broker-dealer is very close. Here in the UK, it's the FCA and the AML D5 digital asset registration. In continental Europe, we're regulated by the AFM in the Netherlands, the central bank, the DNB, and that gave us access to the MiCA setup, which again is a big deal. And so is that going to allow the native crypto clients to trade more? I don't think so. I think it's a lot of institutional capital has been sitting on the sidelines because there's been a lack of convenient way to access the market or a safe way to access the market. And so those start to be the names that Tommy was talking to, the big pension funds, the endowments, the banks, right? Like that's what's going to unlock. But we still have a very, very long way to go, infrastructure-wise, regulatory-wise. And my fear on the regulated or with the regulators is that they try to shoehorn this into existing TradFi regs. And that might not be the best idea when we have the opportunity to create something new and unique. And so my thought around this is like the early days of the internet. It's a pro-innovative, light-touch regulation to learn how we should govern this.
Regulations is key. There's a summit in the White House, Crypto Summit on Friday, right? So imagine they're going to be laying out some sort of framework in terms of regulation and what they want to do. Maybe do you think that's why a lot of the institutional capital is still holding off, even though they're excited about it and what Trump is saying, but they kind of need to know what the land looks like.
I think it's. Oh, sorry, Sean.
I got two. I got this kind of thing about sideways kind of ideas, but go ahead.
No,
my sideways. I think the people think this is all super crazy voodoo stuff. It comes down to some basics, and the basics are, to kind of answer your point, how do you account for it, right? And how do you tax it? The two biggest problems with our industry. In a lot of countries, the regulator sits there. Staking's a great example. What's staking? Well, it's not an investment opportunity. It's not, you fails the Howey test, whatever. And it's not a bank deposit, because clearly it isn't. So what is it? And I always give the example is staking is actually like, I'm a incredibly rich dude. I've got a Gulfstream, whatever, jet. So I give it to a leasing company, and they let other slightly less ridiculously rich people fly it around the world for a fee. So it's an asset which you get rent from.
It's like rent, yeah.
It's like rent, right?
Yeah.
And so when you look at it like that, and I give this example, and everyone says, oh yeah, that's right. Yeah. And so when you go to the accountant, you go, it's just like a jet. It's just like a jet with leasing. And they go, oh yeah, great. And then I can account for it. But until you get to that point of all of the big four accounting firms being able to sit down there and go, here's the accounting for it, step one. And then step two is the tax man to come along and go, okay, great. It's not this stupid, capital gains, 100% nonsense and all this kind of stuff.
I agree with that. I think, just two quick comments. One, the United States FASB codified the accounting standards for digital assets. So we're seeing progress, but it's not fully there yet. And then again, you have this fragmentation across different regulators and different taxmen coming to get you. And so where do you book these things is not quite clear. And that the motivation from the trading pods in the hedge funds, as an example, is there, but they fail internally to get past finance, accounting, legal, because the legal framework's not.
Is it property? Is it a commodity?
Correct.
Is it a financial transaction?
Is it a security?
Is it a security?
And in the U.S., you have state MTLs, which is, that's pretty difficult to navigate. New York and California have the akin to BIT licenses, but navigating all of those are very, very difficult. And Sean, I completely agree with your point around taxes and accounting.
I heard that was a big chunk of the money that came into the ETFs was only that there were a number of traditional finance and regularly kind of normal corporates that were owning Bitcoin, and their struggle was they can't account for it. Mm-hmm. So they looked at the ETF and went, well, if I could just convert that into the ETF, then I book it as a security and everyone's happy. Until that point, the CFO was going, okay, well, what do we do with this thing? How do we?
I think it's a very fair point. We've seen it ourselves, and we're lucky enough to have E&Y as our global auditors. And that in itself presents challenges, right? We're regulated in multiple jurisdictions as well, and there's a lot of fragmentation on that regulation, right? And so, it's a challenge for everyone, especially as you're trying to grow a global business. But I think Mike's point that we need to be forward looking at regulation is pretty clear, right? I think it's a very difficult asset class to fit into. Okay, looks and feels a little bit like FX in some ways. Looks and feels a little bit like commodities. We're also regulated by the CFTC, and I think that's again a plus for credible firms such as ourselves to face such regulation, because we don't take that lightly. I mean, there's a burden and an obligation with that. But yeah, there's to your point on there's obstacles for that institutional adoption, and I think that's a very good point from Sean, that the way you even account for some of these positions, the way you tax them, these are all they're all actually also addressable, right? And so I think that it has to be bilateral, and to be fair to the US. That's what, as an outsider looking into the US, we're a US headquartered firm, but this is all the positive, and this is why the crypto native community is very amped up over there.
Can I kind of challenge a little bit your point about institutional money, and this just for kind of coffee conversation. So one of the things I noticed in the last couple of months, if you go to the conferences that we all kind of buzz around, I think that there is a slight change in the vibe, and the vibe is this. For the last couple of years, you got the alternative asset managers, the people that were doing distressed debt or kind of commodities, kind of riskier asset classes. They were all turning up to the conferences crypto curious, right? They weren't investing, even though they had a mandate of 1% or 2%. They weren't actually buying so much of crypto. I think they are now bringing assets to bear, and I think you see that in the $10 and $20 million crypto hedge fund, who was kind of struggling a bit to get momentum, and now phones ringing a bit more. And I'm not saying they're scaling to half a yard or anything like that, but they're getting phones kind of ringing. And I think also what you see is the equities and the fixed income asset managers, which wouldn't turn up to the events, they're now at the events as the crypto curious bunch. They're not putting any money there, but they're sending the business development guy or somebody along. I think there is, don't get me wrong, I'm not saying they're all piling in. I'm just saying I think there's a flavor of change.
Can I jump in on that? So I agree. I think it's still very, very early on in crypto, but going back to the United States as an example, I'm an American, the launch of BlackRock's ByBit ETF was the most successful ETF ever. Yep. So even without the outflows, let's put this in context, which just goes to show you that there was massive pent-up demand in one of the world's largest investment markets. And so the United States, it's important for one reason. It's the US is a very, very, very equity-centric market. And so taking Bitcoin, putting it into a regulated, acceptable equity format allowed people to come into the space. And if you look at that, and those are public, you can see who's holding them. They are the largest hedge funds in the world. And, is it sticky money or not? They're running basis. Basis just collapsed, right? I'm long ETF, I'm short CME front month. So I'm actually trading crypto without ever touching it. I'm trading a regulated derivative on the CME side and a regulated security on the ETF side. And so I think as we've all tried to highlight that as you start to, again, not shoehorn this into a security or a commodity or anything along those lines, but to clearly define what that looks like, those institutions that are crypto curious on will make that push. Many of them have actually done it. They've just set up small SVVs in Cayman and put $50, $100 million in. But I'm talking about the master funds coming properly in. I don't think we're that far away. And then the last thing I'd say is why that has changed is not because there was some new regulation. The administration in the United States has changed and had a positive tone. Then there was the previous administration had the knee on the back of the neck of the industry, and people were literally scared to touch it. And they debanked the business. Those things are reputationally largely being removed, but still all the uncertainty needs to be filled in. And only at that point we'll see it.
Can I quickly add? I think I agree with you. I think there was also an element of Chief Compliance Officer and the Chief Risk Officer at all of those firms doesn't get paid to be creative or take risks, right? They get paid just to do everything's exactly the same as it was last year. And so I think there was an element for the ETF where those two archetypal roles could kind of go, oh, okay, so then everyone's all right with this, are they?
Exactly.
And then everyone starts to get more comfortable, and you see people, business development people turning up at events. I think this was.
We've all had to deal with the banks, right? In the traditional markets, we bank with JP Morgan and Boney and Barclays. In the digital asset space, those names are vastly different. They've done a great job, but when you're the CFO of a firm and you say, well, can our current bank do this? And the answer is no, red flags go off. Just kind of maybe tying this back into Deribit, who's been awesome bringing us here and relating it to the ByBit ETF. You saw ByBit ETF's options on that launched. It was, I believe, November 19th. It traded 73,000 contracts in the first 60 minutes, making it the top 20 non-index product. So that just goes to show, again, the pent-up demand. Now, why options are super important is they're mature products. They dampen the downside to this 60 vol asset class that kind of needs to start happening. And so, Deribit, as an example, is the leader in the digital asset options business, is a really, really important ingredient for institutions to come in because they're very familiar with trading those mature, more complex products. And I think there needs to be prime brokerage to help clear those trades from Deribit against CME, against the ETF, because again, there's fragmentation. There's capital inefficiencies to that. And that is where these scaled up intermediaries like prime brokers tend to add real value for institutions because they're never just going to trade on a single destination because they have that fiduciary responsibility to source best price, improve TCA because they have LPs or investors or their brokers and they have end clients. So Deribit does a great job. We all support Deribit, I believe. And, again, options, you can see that coming from the TradFi space and Deribit, leads that space.
I think, look, I totally concur with Deribit's importance to the crypto ecosystem, right? And so options are a key part of getting more institutions into crypto. To Sean's point on institutional adoption, I think we can all see the 13 Fs. I think it's reasonable to assume that all of those hedge funds are basis, right? Listed basis. And why do I say that? Because every one of them typically is a multi-strat. And so by definition, no multi-strat is going to allow their PMs in any pod, commodities or FX, to run a 60 vol asset unhedged. Right, that's just not that's not how they run their firms. And so I think it's great that they've come in and traded listed ETFs versus listed futures. I guess the next thing, and there is a role for us to play in that ecosystem, that fragmented ecosystem between your security regulated broker dealer, your crypto native regulated prime broker, and Hidden Road, where you're an FCM and sort of overlap on both. So I think, but the real question is, okay, how do we get them into the crypto natives? How do we get those hedge funds trading native, right? Because that's the next step. And so, yeah, we see the liquidity coming into Bitcoin, right? But we do, we'd love those hedge funds, these $60 billion hedge funds trading native, right? The lock token deals, great trade for a hedge fund. Right now, you've got options on Deribit. You can actually hedge out that risk. You can look at an asset. You can be locked in. They do this day in, day out on M&A activity, on distressed debt, on debt to equity swaps. And so this is their DNA. I think they'll price risk very well. They'll price risk better than maybe some of the market participants that are active right now. And so it'll help the foundations raise more capital. It'll help the ecosystem with more liquidity. And again, Deribit being a kind of pivotal role to that through the liquidity and options.
I have this dinner party conversation with people about risk distribution. So I say in equities, you have a very efficient distribution of risks from people who hold assets and want returns down to arbitrage and speculators and the whole kind of ecosystem, and risk kind of bounces up and down depending upon what's happening in the world. But in crypto, it doesn't. What happens is price discovery and liquidity happens in crypto native, and it happens on places like Deribit and places like that. It's a very efficient market. However, it stops at the point of high quality but still crypto native players. And then the other side of that line is CME and other holders of crypto. And so you get the rich clients of some investment bank who are having structured product written or repo. And those investment banks lay off on CME, and then the risk stops at CME. And so part of our kind of part of the whole answer is to be an intermediate and to kind of offer those two platforms and to be able to cross it. But there's also a requirement for example, licensed exchanges to become licensed and become licensed under TradFi and be able to be accessed by those TradFi players as well as crypto players. Because I think there's a gap between our ecosystems and risk is not being efficiently distributed.
Yeah, I agree. And like just going back to the point on the CME, like you don't really self-clear on the CME. It's an option, but there's very, very select few firms that self-clear on the CME, which means you need an FCM, GCM to clear, and then you can go into the clearinghouse model of that. But to be clear, why don't they self-clear? Because they're usually trading other assets that are correlated and getting offsets from those prime brokers that are providing that balance sheet to it. And so even if these digital asset exchanges get regulated, is the right solution to post your assets to them and trade there. Again, my view is you separate the function of trading from where your assets are held, and that'll force people to really play and be experts in their space. This bundling of services and blurred lines is dangerous.
I think it's a great point, and it's probably a good time to move on to off-exchange settlement, because I'm sure all three firms are investing heavily in resourcing that development. For us, off-exchange settlement is that accelerator of institutional adoption, right? And so we can't change Basel short term, right? Hopefully we're all aligned that it will change in time, but that's really a big hurdle for the banks offering, serving that big sort of multi-strat hedge fund and institutional capital, right? And so we've sort of touched on that. But what we can do is target that institutional capital, not channeling through a traditional prime broker, but channeling through a native prime broker, a digital prime broker, working with some very big names in the custodial space. Right. And, I suppose we don't really want to get into specific names because there's such a suite of them. But, we all know that there's large custodians, TradFi custodians entering the digital space with very well capitalized businesses that are offering off exchange settlement to venues such as Deribit. And we're super excited about that. I think that's transformational for the crypto ecosystem. And it's also tangible, right? We can see change this year. The pipeline's actually enormous for first half of the year. I think we're all on board in with, you get sort of FOMO over Hidden Road Alive or LTP Alive or a FalconX Alive, I think in a good way, right? There's competition, but that's good for our institutional clients. And I think to Sean's point, there's definitely more crypto curious. I see them at the conferences as well. I just don't see them trading native yet. Right. I think off-exchange settlement is actually that. Here's a catalyst to get that community trading through any of the primes.
Yeah. So that off-exchange custody solution. So we were doing a part of our DNA is to do what the client wants, not what we want to do. So like you guys, there's this kind of there's a selection that we offer. It's not just one, and that was client demand. Clients would come up to you and they go, hey, look, there's the question of credit quality broadly in the industry. So I want to keep my assets where I can cite them. Maybe that's under a pledge agreement, or maybe it's more integrated with an exchange. Either way, it's recognizing this fact that people want to cite their assets in the way that you were talking about your question earlier on. I think ByBit was excellent in what they did, but I think the event did also crystallize people on trying to make that choice to use third-party custodians. I think it will become much more of an element of our industry, in a way that in equities, you'd always ever leave your assets with the broker, and they'd always only ever post them on the exchange if it was allowed to use, if they were posting T-bills or something like that was acceptable on the exchange. I think what will differentiate crypto from traditional finance is the idea that there's a delineation between where your assets are held and who gets to use that pool of assets to make other financial transactions in other pools of liquidity.
So I agree, but in part with that, actually, I do think if we look at, so the concept of a triparty agreement or an ACA isn't new, right? And so if you look at UCITS, even in European UCITS, the AUM in UCITS is assigned to be over $1 trillion. Most of those UCITS are trading derivatives via triparty, right? And so they're going to the large prime brokers, trading on swap in markets where it's efficient to trade on swap, right? UK, France, etc. And holding that asset with the custodian, just under standard triparty. And so that's the beauty of off-exchange settlement for us. And I agree, we want to provide a suite of offerings rather than be partnered with one or two specific. Clearly, some names will appeal more to the institutional investor, and some of the big crypto native custodians have very bona fide, strong products, right, and have been battle tested. So I think it's the client's choice. But I think we're not creating anything new here. This is triparty works. I've been lucky enough to work in firms where they do billions of dollars a day using this ecosystem, and actually you can get pretty advanced risk system. And so you can say, hey, you want to trade a airline stock on swap, right? I can look through into your custodian real time and see your whole full portfolio, and I won't take an airline stock as collateral because I'm too much risk. I'll take one of your bank holdings, right? And so I think crypto being crypto, on a technology front, I think all three of us will have platforms that we think would hold up with any prime broker in terms of how we assess risk, because we've had to. But yeah, keen for Mike's view there as well.
Yeah, no, I completely agree. I think that is the way forward, is these tri-party solutions. Again, you see it in other asset classes. I don't think crypto is different, but to Tommy's point, on the technology side, being able to ingest that information, perhaps 24/7, right, weekends as well, is a technology advantage versus the traditional markets. The other thing I'd say is, again, you're starting to see this conversion of traditional products and digital assets. A good example of that is foreign exchange. You don't just trade Bitcoin against dollars. You trade Bitcoin against euros. You trade Bitcoin against yen. You trade Bitcoin against sterling, right? And so those worlds are already being merged. And if you look at the banking rails on foreign exchange, these are largely T2 settled. Crypto is T instant, right? And so, how do you move those things together? There's a lot of work to be done on the just to circle back on the tri-party side of it. Hidden Road already has counterparties that hold their assets in a tier 1 bank away from Hidden Road. Hidden Road trades on an exchange where our assets are held away. And so there are very large institutions who've come in, face a regulated entity, take no counterparty credit risk. And beyond that, Hidden Road's not taking the risk to those exchanges. That's a very interesting, very scalable solution. So I completely agree with
where does the CCP model come into all of this?
I can take that one first. Sure. So in terms of
that stands for central counterparty.
Clearing counterparty.
Yeah, exactly. So effectively the likes of CME or Deutsche Börse's Eurex, right? This is what we're referring to. So again, those are great solutions because they generally have general clearing members around them, like the CME as an example. If to be in that club, you have to put money into the waterfall. So you're effectively guaranteeing this clearinghouse, right? And there's a waterfall effect. So when you're trading vis-a-vis an FCM, GCM on a major exchange like a Eurex or a CME, your counterparty credit risk, you feel pretty safe. It's not perfect, but it's very well organized. And then they clear those derivative products, which is great. The problem in digital assets, I go back to this market structure. It is not a centralized market. It is an OTC market at trade, because I can trade with Sean or Tommy at any point my Bitcoin against my dollars or my euros or whatever that may be, just like I can do euro dollar and trade those where I want. And so CCPs might be great solutions for certain products, but there'll be various CCPs. Great example is in oil markets, right? You trade complex energy all the way down the barrel on CME against ICE. Those are very correlated assets, right? And so you'll want to prime, and they're essentially cleared, but you'll want a PB between those. So I think, from Hidden Road's perspective, we would welcome CCPs to come into the space. Again, very large, well-capitalized, clear waterfall structures, but it doesn't fully solve fragmentation, especially on the spot side. Derivatives may morph to a few large CCPs, but I don't think it's the answer for everything. And I think it's hopefully will be part of how the ecosystem scales and matures.
I agree. Look, I think it's part of as a crypto market infrastructure matures, CCPs will become more relevant, right? Yes. Especially as we get more institutional adoption. There's a few providers out there that make it a big push, right? There's one or two. I'm sure they're partnering with the three of us. It feels a little early still because I don't get, my phone isn't ringing off the hook for CCPs, right? So I think it's very much hand in hand with those institutions coming in.
You need more size, basically.
Needs more size, the type of holders to put your back on, what's my strategy? I think what's quite interesting, if we look at market structure versus a traditional prime and a digital prime, banks, not that they have it easy, but there's typically two-way flow, right? And so if you're sitting in a traditional prime or a Delta One desk, you've got a passive, an equity that's in a passive index, right? Or a passive fund, and its index has been rebalanced. So you've got natural buying appetite, right? This stock is going into a new index, and so people need to buy it. And then the other side, you've got maybe it's a convertible and the hedge fund's shorting the stock against buying the convertible. And so you've got this beautiful two-way flow, and you can just be a broker, sit in the middle, execute both legs, finance both legs, and make a lot of money. Like, you just don't see that in crypto, right? People are typically one way. And so, again, it's just a challenge because there's no natural
strategy.
Yeah, well, yeah, I mean, to the point, to MicroStrategy's credit, I mean, the way they've structured that convertible has been very, very clever, right? They've effectively offered volatility much cheaper to these hedge funds.
Exactly.
You can borrow the stock pretty easily. It's in some of the indices now and the ETFs, right? And so there's stock out there to borrow cheaply, which is important. And it's a high delta. Most of the tranches have been quite high delta. And so to put that into sort of crypto layman terms, I can buy the convertible, fund it by shorting the stock to a large portion of the value of that convertible, and just sit on it for carry. So they've been very clever in how they've structured it. But yeah, it's a great example of, we just don't see that two-way flow currently in crypto. I think the more types of different strategies we get in, and the more, again, pointed back to institutional adoption. So I feel what crypto does really well, to your point, and I really like that point on pricing risk. I think crypto natives price risk incredibly well because they've had to. They've grown up in the most efficient market asset class that we've ever seen, right? And then you now have the likes of Citadel Securities coming in public, Susquehanna, some of the most efficient institutional, risk pricing agents out there, right? And then, how does that align with the institutional adoption coming through, where you may have some 130-30 funds aren't going to trade it that often, right? And so it's a really exciting time as we see that evolve. But going back to CCPs, I really don't see it as an immediate short term. I think medium, long term, to Mike and Sean's point, it'll be a thing.
Can I add on? My perspective on that is, so we have a lot of conversation with CCPs, and definitely it's a thing, right? They're coming up and saying we're regulated and we got relatively larger capital, we're independent, all those kind of good value propositions which the CCP has, ignoring the cost and added layers of intermediation, whatever. Single biggest problem I see in all of them when I look at them is they're typically licensed with a TradFi license, which means they cannot settle crypto. This is the biggest problem with them. I go, great, it's cool, your value proposition, I get it, it's already cool. Maybe you've got some crazy risk model or whatever. And they go, and can you take Tether as collateral? No. They go, can you settle anything on chain? They go, no, it's just fiat. And I go, hey, look, this is great. Don't get me wrong. I'm super supportive. But unless you can bring, like I said, the two worlds together, the crypto natives where liquidity and price discovery is, versus the TradFi lump of money that everyone wants to come into the asset class, it's going to be a hard task.
And this TradFi lump of money, look, I'm a trader, so for me, I want to know when that wave is happening, because when that wave comes, then potentially last year's rally is going to look insignificant, right? So do you think that's a 2025 story, or is that a 26 story, based on what you're seeing and the speed at which these people are trying to come in?
Yeah, I guess this is the classic what's the price of Bitcoin in a year time kind of interview question, right? I think there are a couple of things which are interesting. The number of markets that you see are serious about encouraging the asset class, Hong Kong, the US now, and other places like that. I think that's quite a positive sign. I mean, Trump in the US, it's just undeniable that that's going to have an effect of saying to people it's okay to access this asset class. So definitely, really the winds of change of 180 degrees. But I think that there's still some, other than Bitcoin and things like ETH to a lesser extent, there has to be some other maturation in the element that we haven't talked about at all until now, which is the underlying coins themselves. Many of them have to mature beyond their just, it's a cool thing, and actually have a real use case with a real ecosystem that people are using for things other than trading or other than speculative investments. And I think until that happens, it's difficult to see how there's a scale and momentum that you see in Bitcoin across the other coins.
So you don't think Fartcoin's reaching that maturity?
I mean, the other element, is the interesting topic, is the number of people that list their own coin. And there was an article, or someone wrote a couple of days ago about every firm's going to be a stablecoin issuer. And I'm like, no, they're not. They're not. It's going to be a couple of stable coins, and there'll be a couple of key assets that are, of course, Bitcoin's going to be one, and a few others. It's a 20 coin world in 50 years' time.
Can I just add to, like, maybe it's the timing of this, and whether I'm not going to try to predict if it's 25 or 26, but the question is, how long is it going to happen? And so I think largely, regulators and governments think, this notion that it's a gimmick is kind of long gone. So that's a step in the right direction. But I thought to give like an interesting statistic, right? And so the BIS, the Bank of International Settlements, did a report in 1995 in foreign exchange that the total turnover in that market was $1.2 trillion a day. There was zero prime brokerage infrastructure, and only because of that, there was really no convenient way, again, to access the market. There was no industrial scale. There was a few bespoke deals, right? You had Soros and Tudor and Morecap and maybe the Tigers of the world that had access. Fast forward to 2019, the BIS redid that report, and the market cap grew to 6.6 trillion, with 1.5 trillion going through PBs. So 25 years later, proper infrastructure getting laid down, you saw the market scale, and some of the names Tommy mentioned before are some of the largest names in the foreign exchange markets. In fact, one of the largest market makers in foreign exchange isn't a bank anymore, it's a non-bank, and that was the ability for that to happen was infrastructure. Again, this is a prime brokerage panel, so I thought, to use that. If you look at the development of interest rate swaps, right? ISDA was started, documentation was awful. Okay, it started in the 1980s because there was demand for fixed versus floating, right? And there was this lack of standardization. It took till 2013 for the market to have mandatory clearing. That's 30 years. And so crypto is still very, very early on. We were talking backstage before that, it's like watching what we watched, in our careers for 20, 30 years, just on fast forward. Is it 2025? Look, we sit in an interesting position. We are talking to, the largest trading firms who've actually put together digital asset teams looking at all sorts of it, not just trading crypto, but, digital assets in real world, RWAs and what this means to them. They're all starting to mobilize a little bit more. Will they have a pod or two of those in production trading in 2025? I'd say so.
I think it's a very good question. I'd probably break it down into two parts. One, can investors, traditional institutional investors, make money with the current crypto ecosystem and market structure and just volumes? And the answer to that is yes, right? The IRRs from some of these hedge funds that have started and have put up teams and trade with, all three and direct exchanges is nothing short of sensational, right? And so there's definitely demand to build out those teams. And let's just put some context around that. That means I can run a 300 token, 400 token, 500 token, market neutral. I think token neutral is probably a better term than market neutral. It gets, but we can have a strategy that trades on daily volatility, daily volumes, and high retail participation, and trades really well, right? Now, what's the driver of that? The ultimate driver of that is high retail participation and very fragmented liquidity. And so if we just take those statements of, do I think 25 we're going to see high retail participation fragmented? Yes. So I think there's a very strong track for opportunity for some people, which hence we've seen some big names coming back in or are deploying more resources into crypto, because there's still a fantastic opportunity. That's one pool. Then we have the other pool, to the second part of the question on, how does it evolve? How do we get more institutional money coming in? Do we see changes? I think the great thing at crypto, we touched on backstage, is we see advancements much quicker than any other asset class, right? And so just, yes, I totally concur with the examples Mike's given. But, given Trump and the amped up support we've seen in the US, you know, the headlines now coming through are thick and fast. Are we going to get FOMO from other regions? You know, Sean's mentioned the way Hong Kong have effectively U-turned, right? And you know, congratulations for you guys to sort of jump on that opportunity and champion that. I'm phenomenally excited for 25. And it's hard to say, to Mike's point on whether it's 25, 26, we're prepared for change. But the good news is, even if that pace of change is faster or slower, there's a role for the traditional the digital prime brokers currently, because we have appetite from new entrants and existing entrants that you can still make quite a lot of money and a decent IRR. And then you look forward at, okay, these other institutions do come in. That's, you know, I don't see liquidity not being fragmented in the short term. I think that's ultimately a key driver for how the ecosystem looks and how we support that ecosystem.
Guys, I think we've hit time, but what an amazing panel. Huh?
Yeah.
You guys, I mean, you did the job for us. It was amazing.
Yeah.
Yeah, I really appreciate you coming on the show, guys.
Thanks.
They're really interesting, and lots to build, but certainly the role of the prime broker, I think anyone listening to this is going to be central to that. So great to get your insights, and thank you all for coming on.
Thanks for having us.
Take care.
Cheers.